Hello there and welcome once again to, well, another version of Open Door from propertyCEO. It's good to have you here. My name's Ritchie as always. And over the next 30 minutes, we're going to be taking a deep dive into the world of small-scale property development. We're going to be talking to movers and shakers, people out there that can help you, guide and steer you on this journey in whatever's happening in the world of property. And we'll also be shining the light on areas that we think could be a good opportunity for new developers to take a look at. Above all, going to have a bit of fun because life, as we always say, is definitely too short not to. So what's coming up on today's show? Well, it's a subject actually which a lot of people just ignore. They don't even think about it until it's too late. And then they've got to rush around and get hold of it. When we think about property development, new developers want to get into property and they think about, well, yeah, I'm going to have to get hold of a contractor, I'm going to have to get hold of an architect, yeah, structural engineer, project manager, cost consultant, estate agents. But what about insurance? What about if things go wrong? Hopefully they don't. Touch wood here on my desk. Hopefully they never do. But of course, if they do, you've got to have the right insurance system in place. And of course, it can be a bit of a minefield. So you need people that are expert in the world of property and property development. Because if you just go to a local insurance broker who insured your car, I mean, they might be able to, but the chances are they won't have the expertise. So you need to get out there. You need to get hold of someone who can guide and steer you in the world of insurance, all associated with property development. So I'm pleased to say we have someone here who, well, hopefully they're going to give us a bit of an insight into that. So I've got today on today's show, I've got Josh Munt. He's an account executive. He's been there, I think, in the industry now, 11 or 12 years. He works at a company called Insurance Desk Services. I know his colleague, he works with John Cox, and I know him very well. Good bunch of guys and girls. Obviously, there's ladies there as well. They're a really good team. And they are a real go-to person out there. They work out in the industry. They do help a lot of people. So let's welcome Josh. Josh, welcome to today's show. Josh Munt, how are you?
Yeah, very well. Thanks for having me on, Ritchie. Good introduction.
Did I build you up a little bit too much, my friend?
Never too much, never too much. That was perfect. That's perfect.
Good stuff, good stuff. So where are you joining us from today, Josh? Whereabouts in the country are you?
So based in sunny Aylesbury, of all places. Yeah, so Buckinghamshire.
Good stuff. And as an insurance company, you're based in Aylesbury, but you cover the whole of the UK?
Yeah, being sort of experts in property, we can't really be local, so we are everywhere, all over the UK. Got a few bits abroad as well, so yeah, there's no specific location.
Truly international. Wow, good stuff. Josh, we're going to talk about the world of insurance and property development. And I think, as I said in that brief introduction, a lot of people don't think about insurance, especially. They always think about those other things. Is that something that you find people often coming to you too late?
Definitely. And especially when we're looking at property meets that we go to a lot of, I think it seems to be a bit of a taboo subject, really. You alluded to the fact that everyone gets their specialist consultants in tax, mortgages, planning. But why is insurance done directly without speaking to an expert consultant? And that's the part, I think, where it gets a bad rap. Because if it doesn't go in correctly at the start, it's not going to get paid out correctly at the other end. So it definitely needs someone to guide you. And when we're talking about developers, there's lots and lots of different things and different ways to insure. So it's definitely worth speaking with someone who knows what they're doing.
Yeah, so I think probably it's a lack of understanding. And I think it's a lack of understanding by certainly a number. I mean, we meet quite regularly at a Partners in Property event, great networking event across the country if you're interested in that. Those guys and girls got their eyes open to it. But certainly some property networking groups that I've been to don't have a sort of a bent towards insurance services. So let's delve into it. If I'm a prospective property developer, so I've got a lot of people listening to our show here who are either in or interested to get into property development, and we're thinking about insurance. So we're going to take, let's say, an existing building, maybe as a first example, Josh, to convert and develop into some flats, for instance, under permitted development. What do we got to be thinking about insurance? What's our sort of options?
So the key one will be your buildings insurance. So very much like an occupied property owners, where you can buy your landlord's policies, apart from it's specific to an unoccupied property. So what you need to declare is all the different things you're doing to it. So are you extending it? Are you doing an internal refurb only? Is it commercial to resi? And then just telling the insurer throughout what your plans are. So with that, that's quite straightforward. Where you can get caught out is that, and the insurers will then give you different levels of cover. So you might say, oh, I quite like that premium, let's take it, without looking at the cover. So That's traditionally where
what could we get in different covers then? You say we could get, I can see that point of an attractive premium, but we're going to insure this building that we're going to convert, which is presumably vacant. What could the different levels of cover, if you know what I mean?
Yeah, so generically, an insurer will restrict it right down to something called FLEA, which is fire, lightning, explosion, earthquake, and aircraft. That's it. So if you're looking at a risk from a UK perspective, that's pretty much fire only, isn't it? I mean, you're not really going to get many of the other events there. So if you're taking a fire policy only, you've really got to understand that is all it's covering. So events such as storm, flood, malicious damage, all different things that can happen at any time, you're not going to be covered for. And especially in today's market, claims costs are through the roof. So a small storm claim could be, 3,000 or 4,000, if not more, depending on how bad it is. So you really could leave yourself exposed by not doing an extended perils cover.
So I'm guessing if we're talking about an existing building, it's going to lie empty for a period of time because we're going to be applying for the permissions to convert it, getting our team together, tendering it. And malicious damage is obviously a real big possibility, isn't it? People are quite likely to go into these buildings and trash them. Have you had experience of that happening for your clients?
Yes, definitely. And that's one reason why the insurers want to restrict that cover, particularly because it is one of their biggest risks. So a big commercial unit or a big residential property, especially if it's boarded, it screams empty. So people will try and get in and they can do all sorts of damage in there. So it is definitely one of those, what we call them perils, in other word, events. It's probably a better term, but those events can happen quite easily and they're frequent.
And you talked about flood as well. Could that flood, I mean, obviously if people go in, they trash the place, they could cut the pipes, and flood the place. Or of course, if the building's empty, is unheated, we could get some freezing of the pipes, they burst and that floods. You wouldn't be covered unless that's specifically on your policy, would you?
So that would be an escape of water. So that is a different event that will be covered that you can extend to on an insurance policy. But flood predominantly is from burst riverbanks or surface water rising from beneath. So both can be covered on an extended perils one. And again, you've just highlighted another event that you weren't thinking about, but it could happen and you would need an extended perils policy for it. And we touched upon it just at the start there about premium. Yes, premium's obviously important. We want to get it as low as possible. But I think the cover should be thought of first and then try and get your premium down to the cover that you're comfortable with. I mean, we find it funny, me and John say a lot of the time that investors will be spending hundreds of thousands on a development and then they'll sort of negotiate over £150 of premium when you look at the cover differences. Yes. It's staggering.
I was thinking of that. I was thinking of exactly that. And I remember a policy of a scheme that we did, and it was insuring about £800,000 or £900,000 of buildings sat there, empty buildings. And I don't know, I had cause to pull it out the day. Someone was asking me something about the specific project because we used it as a demonstration project, and I pulled it out. And from memory, it was about £1,500. And you're making several £100,000 profit, and it's a like £1,500 policy, and it's all encompassing as we're talking about today. But yeah, you're right. You're sort of those small numbers you're arguing over, and you're losing the fact that you could get a burst water pipe. So let's cover it. Let's cover that because it could happen.
Exactly. I mean, if I was an insurance company and you were giving me £800,000 of risk, I mean, I wouldn't want to take £1,500 for that risk. I wouldn't sleep at night for that. Okay, they do it on a big grand scale, but you can see the enormity of the risk compared to the premium. So yeah, okay, we're biased because we're in the industry, but definitely it's about cover first and then try and get your premium as low as possible once you're comfortable with the cover.
I like that cover first. I think that's important. I understand what we've got to cover. So let's go back then. We're talking about getting our building. Our building is empty. We're going to get the appropriate cover, which is going to cover us from malicious damage, flood if someone cuts the pipes, flood from rivers, fire, as we said. Is there any other sort of slightly more obscure covers that people don't think about that maybe we need?
Generically, a buildings policy will have events listed from say 1 to 12, which would include all the standard covers that you would normally get. So when you talk about full perils, full events, then that will give you what you need for the building's existing structure. What you might need to look at is the contract works, because there are works going on the property. Who's covering them? Have you appointed a main contractor, or are you contract managing yourself and appointing individual trades?
Okay.
Because especially with a new build, for example, with an extension, if you're not appointing a main contractor and the extension would not form part of the existing structure, then you need to cover that either as an addition or separately, because if that burns down before practical completion or something happens to it, you're going to need the funds to put it back to how it was to complete it. Otherwise, you're starting from scratch and you've pumped 100,000 into bricks and mortar that you're not getting back. So again, the contract works is quite key.
So going back to this contractor then, because you're going to buy this building as a developer, you're going to insure it for a period of time, then the contractor takes over. So we've got this issue, I guess, does the contractor insure the building under his own policy and your policy stops? Or do you have a combined policy? How does that work? How do we unravel that?
It tends to work together in conjunction. Now, it's where it can get complicated, because the builder's insurer won't cover the contract works unless they specifically extend, which is unusual. The contractor's policy won't cover the existing structure. So you've got two different policies covering two events with two insurers on the same building. So it's about making sure you're comfortable with the contractor's policy. And again, sometimes I will check over a developer's contractor's policy to make sure it looks good, because the key points they must have is their public liability, and then they're covering their contract works as well, because you want to know that if there is an event that the contractor is insured correctly, he's going to get a quick payout. He can then resume back to where it was, and there's not a long delay throughout that development. You can bring it together. So we could touch upon that on different sort of projects, but there are ways that you can bring the contract works and the existing structure together on one policy.
I guess then, because if you've got two separate policies, so you've got your policy covering that existing building, which carries on. You've got the contractor comes in, which covers his works. What if the contractor sets fire to the existing building by accident? Whose policy kicks in?
That usually it has to have negligence. So for the contractor to be liable, there will be negligence there. So if he has set fire to it during works, then yes, there's most likely going to be a negligent part on the contractor. That will be under his public liability. So that should then cover all the damage. Whereas if there's a fire that hasn't arisen from the works, you're going to have to, the developer's going to claim on his existing buildings policy. The contractor is going to have to make a separate claim for the works that are practically complete yet. So then you're going to have two claims.
Wow. So two insurance companies potentially working on one claim and trying to find out whose fault and what they've got to cover. You just mentioned briefly, Josh, let's go back to that. You can get these policies joined together. Is that quite common?
It's more common on if there's JCTs involved. So if you've got a contract with the builder, then...
And a JCT, for those that don't know, is a joint contracts tribunal. It's a standard industry contract that we use to contract ourselves as developers with the contractor, isn't it? So if we're under a JCT, that helps, does it?
Precisely, yeah, because in there are clauses. There's usually 3 different ones you can choose from, and it will either state that developer and contractor insure separately, or that it states that they have to insure together. Now, when it states that they have to insure together, well, you've got a contract clause there, so you should then be insuring it together under one, in joint names, covering the existing structure and the development. It's all covered under one policy of one insurer, and that can make claims a hell of a lot easier.
Do the contractors buy into that, or is that just part of the JCT negotiations that you say, you may have your own insurance, Mr. Contractor, which presumably they'd have to pay a premium for the project anyway. We want to extend your cover under our insurance company. Please, so our broker is Insurance Desk Services. Please speak with them. That wouldn't be unreasonable, would it?
This is where it can get a bit complicated on the smaller developments, because the contractor probably doesn't know what he signed on the JCT. He doesn't know the insurance provisions in there. He or she will say, oh, hang on, I've got my contractor risk policy. I'm not paying for another one. Why do I need another one for this single project? And then the developer saying, well, we have to have it. And it can become a bit of a conflict. However, maybe it's a point that they need to discuss the insurance provisions before they sign the JCT, and which clause that they choose. It will be A, B, or C. And that should then iron out the insurance cost.
What I'm thinking is that's an early discussion, I'm guessing, with your project manager, you as a developer.
Yes.
Maybe bring someone like yourself in, Josh. Would you be able to come in at that stage for developers and help have that discussion with the contractor as well?
Yeah, that's tend to where if there's a lender involved, then that's where we will come in, because the lender will have looked at it and say, right, okay, we need this and this. It needs to be insured like this. And that's how we get involved. If there's no lender and it's unencumbered, that's potentially going to be an area where you're going to miss it. And we might not become involved to the very end. And even then you might not insure correctly because you don't know the provisions of the JCT. So yes, I mean, it's best to get on it early. If you've got a development, you should be looking at the buildings anyway prior to exchange. So at that point, you should look at it. And when you're then looking at doing the works and get a contractor in, again, speak with us and say, look, this is what's happening. What do you advise? Where should we go from here?
What about going back? You talked about lenders, Josh. Let's extend that conversation, because lenders will often want to be named in these policies as well, won't they? Because they've got the stepping rights.
Yeah, absolutely. I mean, they're becoming stricter and stricter. They've got a risk that they want to make sure they're fundamentally covered from A to Z. And one thing we're seeing a lot more is first loss payees.
What's that? Say that term again.
So it's called first loss payee.
Okay, what does that mean?
And that gives the lender the right to proceed and handle a claim over a certain amount, usually minimum 50,000. But what it does do, because an insurance contract, without being too complex, it covers the insurer and the policyholder. There's a contract between the two. When you write a first loss payee, it allows a lender to become a third party as such. And insurers really, really don't like it. So there's a select few that will do it. And then you're throwing in unoccupied, undergoing heavy works. There's an even smaller pool of insurers. So then try and get first loss payees in there. It can become a headache. So if you've got a lender that wants first loss payees, it's best to note it first, because then we can go specifically to insurers we know that can do it. And then you're not last minute, day before exchange. Oh God, I need the first loss payee on there. What do I do? And everyone's trying to find a specific policy.
I guess in terms of that headache, though, providing we've got someone like you on board, Josh, that's your headache. It's not mine, is it?
Oh, absolutely. Yeah. There's been many times on a Friday afternoon where it's been, we need this first loss payee, and we've already quoted that. Right, back to the drawing board. Yeah. But yeah, exactly. If you haven't got a broker and you're doing it yourself, you don't want that headache. It's just not what you need when there's so much going on. But it isn't common. So it is definitely worth picking that out to start with. And we can facilitate quite easily those policies.
If you know where to go at the beginning, it can work.
Exactly. If you know where to go. Yeah.
To talk about the cost of the work, because that's a question that always obviously comes up in a policy. What's the cost of what you're insuring? And this is not the sale value. It's not the gross development value, is it? What's the how do we ascertain that cost?
Great question. It's probably the hottest topic in insurance for property owners right now. We could go on for another half an hour. I won't bore you to death with it, but I'll try and get some key points. I mean, rebuild values. So we're insuring the cost to rebuild the property, and that's from ground up, plus all the planning fees, the professional fees involved, and the removal of all the debris from the event. So all of that then equals the rebuild value. How do you get the rebuild value? That's the question. That sometimes it is a cash purchase. You're going to have no idea.
Yeah.
Or it could be that you've had the property for so long that it's just been going up and up and up with index linking. Well, how do you know it's now insured correctly on renewal day? So there's a couple of tools. There's the RICS BCIS calculator.
So that's RICS, the Royal Institute of Chartered Surveyors, and they have a building cost information service, don't they?
Exactly that, and it's free. You only get 4 free goes though, so it is a bit of a pain if you've got a portfolio. But if you've got one property, it's great. However, it's very vanilla. It will like residential houses, up to a certain size to a certain year of build. So if anything grade listed, anything unusual construction type like SIPs or prefabricated, then it's not going to work. Also, if it's too big, it's not going to work. So at that point, you've lost your free tool to get a guide for your rebuild. So if you've not got recent valuations, I mean, the best advice is to get a valuation, do a rebuild assessment.
And I guess equally, if we are, in terms of as a developer, we're likely to have a cost consultant, a quantity surveyor on board who can give us that rebuild cost anyway, can't they?
If you've got a RIC surveyor or a quantity surveyor that's really experienced, is perfect, because if he can, it's getting him to write it in and put his signature on it. But if you've got that document, then you can go to an insurer and say, look, we've got professional valuation. The insurer's not going to argue with it. They can't really argue with a professional valuation. That's what they want.
Yeah. If we don't have the right number in there, so let's say we had a number of, I talked about that one just now, 800,000, something like that. Let's say we had 600,000 in, but it was an 800,000 rebuild, and we're short. What do we do then?
So that then allows average to come in, and an average clause is that any percentage of underinsurance, any claim can be deducted by that percentage. So even if you had a £3,000 claim, they would then deduct the percentage that you're underinsured. So that is where it can become really dangerous. I mean, 600 to 800 is still a big percentage, but it's not as bad as if you had, 300, because sometimes I think we did a stat and there's a pie chart, and it was something like 65% of rebuild values in the market today are guessed.
Wow. It's
just a pure guess. So if you've gone, right, I purchased it 200,000, in today's rebuild market value, it could be 600, depending on the size. You could be massively under, and okay, on a total loss, it's a wipeout. You're done for, really, aren't you? I mean, how are you going to come up with the funds to put it back? That's how important it is.
Yeah, so that's the point I wanted to get to. Getting this value, even if you've got, I mean, you can do a bit of free stuff off the BCIS. I don't advise people to do that because they don't understand what they're looking at. I think, again, if you're heading towards, particularly as development, as we're chatting around today, Josh, to a six-figure, 100, 200, 300,000 profit, it's worth spending an extra few hundred quid, couple of grand with your quantity surveyor to get that valuation that you know is certain once you're getting this thing insured.
Absolutely. Yeah, absolutely. And I do understand if it's the one development, it's easier. If you've got a portfolio of properties that are, let and churning out a rental income, it does become a tiresome task, but it is so important, especially if you've got 11 properties or more underinsured. Okay, they're not all going to have a claim at the same time, but the chances are increased of one being under. And like we say there, if it's a case where you're losing hundreds of thousands of pounds for insurance that you think you paid for correctly,
yeah,
it all then becomes an absolute mess when there's a problem. So renewal dates a great time to do it, or when you've purchased a property. If you've got lending, they will tend to do a valuation, or like you say, they're actually with a quantity surveyor, they can get it down on paper and you've got a true value and you know that you can be insured correctly.
Josh, just coming back then, we're talking about the beginning, we're going to insure it. In the middle, when the contractor's building it, we're going to have this sort of potentially the best scenario as a joint policy in some way. We then given the building back, it's completely empty, but it's fully refurbished. Presumably, we've got to revalue the insurance cover at that time because we're taking back an empty building that could be susceptible to all those perils, storm damage. It's certainly more likely to be trashed at that point because there's more to trash for those people that want to do that. Presumably, we've got to get that revalued and reinsured again.
Yeah, so you can either do it from the start and over-egg it and accommodate the works. So the end value then should be fairly there or thereabouts. That's a good way of doing it. Downside is unoccupied cover is more expensive. So you'll be paying more at the start than you necessarily need to. Or you would then, like you say, have it revalued once the bulk of the works are done. So if you've had an extension midway through signed off, if that's the first phase, you would then need to then have that added to the existing structure. So you're upping your rebuilds all the way through till you get to practical completion. You might be on a bridge. So if you're coming off a bridge and gone into traditional finance, the new lender might give you a new value. So again, that could
Yep.
save costs. But if you've not got any of that sort of lending going on, yes, you want to get revalued at the end.
Wow. And just last thing I want to pick up, because I know a lot of people, they get confused with homeowner structural warranties as an insurance policy. And I've heard a few people say, oh, why do I need insurance? I'm going to get my homeowner structural warranty. Is that not insurance? So obviously it's completely different. I don't know whether you've ever experienced those sort of comments, or just tell me today, perhaps what is, so people know the difference. What's a homeowner structural warranty? And indeed, is that something you guys deal with?
Yes, a homeowner structural warranty or developer structural warranty. It could be commercial. It could be a big scheme of new builds. It's all pretty much the same, just a different name. So it's giving you traditionally 10 years, can be 12, of structural warranty from the date of practical completion. So if there are structural issues through that period, then the insurer should step in, and then it's going to protect the buyers that will purchase the property, or you if you develop to keep. The key point is that's nearly mandatory with lenders on new builds. If you're trying to sell a new build without a warranty on it, the purchaser's not going to be able to do it. The lender's going to refuse it, and getting retrospective warranties can be costly and troublesome because they haven't had a chance to get their surveyor in from all the ground foundations all the way through the building control. So it's good to get that right in at the start. They are costly.
Yep.
So it's trying to accommodate that in with all your costs that you've got going out right at the start. But that's when it's going to be the best point to get it, before the foundations are laid. So structural warranties, 10 to 12 years, covering the structural integrity of the building.
And as you say, these are very different to the insurances we've been talking about insuring the project. This is the long-term insurance-backed warranty that goes with the building.
Exactly. And with developers, there's a lot more in the way of traditional buildings insurance. So if you're going from ground up, you've got to think about structural warranties, your site liability, the contract works, but also there could be many different types of bonds that you've got to do with the council. So section bonds. You could be looking at performance bonds with contractors. There's a lot more the bigger you get and the higher the development that you want to look at. Well, the risks become higher, don't they? So then you've got insurance to try and mitigate those risks as much as possible.
Final sort of question. When should people bring their insurance advisor in? Right at the beginning, literally as they found a project, or partway through?
Not a Friday afternoon. Definitely not a Friday afternoon. Although we can accommodate, it's stressful. But no, I would always say as early as possible, because it allows us to get the best deals. Because if it is really last minute, well, then we can use the ones that can quote quickly, but it might not be the best deal because the other ones will be a bit slower. So it's getting it in at the start. That will help you control costs, because you know then an idea of what you're paying for insurance amongst other things. And then it can just be smoothly done. So when you've got the green light to be placed, you've got the documents, lender's happy, you can move on. So early as possible.
I'm going to suggest, Josh, and I don't know whether this works for you, but I'm going to suggest anyone who's listening to this today, on this recording, on Open Door, if they're thinking, okay, they're new into development, you're getting into development, don't wait till you've got a project. Reach out to Josh, have a chat. I mean, we've just touched on these subjects today, but have a proper chat with Josh or one of his colleagues about the detail of what you're going to need. Build that relationship before you've got to ring him, maybe on a Friday, and say, I need some cover. Would that make sense to people to do that, Josh?
Yeah, absolutely. Look, even if it's midway through development and you're thinking, oh, actually, what you've discussed there, I might not have had, or if it's something that's coming up that you think, oh, actually, I wouldn't have thought about that, definitely get in touch. We're always here just to have a free review or to discuss anything that we can help with. So there's many ways you can give us a call, and that's 01296 329 610.
Just say that again. If people just grab yourself a pen and paper, Josh is going to give you a phone number. We'll put these in the show notes. But what's that number again, please, Josh?
So 01296 329 610. And then you can get in touch email. So the email is josh@insurance-desk.com.
Excellent. And what's the website?
www.insurance-desk.com.
Good stuff. Excellent. Josh, we'll put those details, if we may, in the show notes for people. And I would say to everyone out there, just reach out, whether it's to insurance desk, whether it's to Josh or one of his colleagues. I mean, I certainly think that would be a good first port of call, but at least reach out to someone at the very early stage and get involved. Josh, look, thanks for coming in. Appreciate that. I think that's going to be some useful information. And I will ask anyone who's listening to this, if you'd like Josh to come back and we'll expand on some of those subjects in the future, let us know. Put any comments, in below in terms on YouTube and or email us if you're on our website. Let us know, and we'll bring Josh back again another day. Josh, thank you very much for coming in. Hopefully that's been useful for you.
Yeah, perfect. Honestly, great avenue to speak about insurance. I know we said at the start it's a bit of a taboo, but if we can reach out to help as many people as possible, that's really helpful. So thank you.
I don't think anyone fell asleep, Josh. I think we're okay.
Oh, yeah, hopefully. It was only half an hour.
Yeah, good stuff. Josh, thanks for coming in. That's absolutely brilliant. Wow, wasn't he good, eh? I mean, look, insurance is a subject, as Josh said, it's we don't really want to talk about it, do we? It's a bit boring. We've got to fill out forms. No one likes filling out forms, but sometimes you have to. Maybe Josh will fill them out for you or one of his team. The important thing I think that you would have picked up from today, as a developer, you need to get that insurance in place and start early. Hopefully you've enjoyed today's show. If you have, give us a like, share it on social media. That's always useful. If you're interested in getting into property development and you'd like to get a bit more information, just take down this link, propertyceo.co.uk/SFR, propertyceo.co.uk/SFR. And that's a bit of free training I put together, which would just get you involved a little bit more in property development. Thanks very much. And we'll see you on the next show.